Now let's look in more detail about those different allocation methods. The first one is straight line method. An example is, for example, a machine costs 10,000 with 800 expected residual value, 5-year expected useful life. How much is the depreciation? Please spend 1 minute, try to work on this example, and you can pause your video for now. So how much is the depreciation under the straight line method? Under straight line, we basically assume that each year we are depreciate it evenly throughout its useful life. So the allocation base is 10,000 minus 800. And we divide it over 5 years useful life. That will give us 1,840. So that is the depreciation each year. Sum of the years digits method. So again, we have machine cost 10,000 with 800 expected residual value, 5 years expected useful life. How much is the depreciation for each year? You can please take 1 minute, try to work on it on your own, and you can pause your video for now. So we have year 0, 1, 2, 3, 4, 5, 5 years. So before the first year, or before we start to depreciate, the book value of the asset is 10,000. And this method is called sum of the years digits method. What do we mean by sum of the years digits? Basically, so now we have 5 years, right? So we just do sum of the years digits, 1 plus 2 plus 3 plus 4 plus 5. How much is it? That's 15. And then so under the sum of the years digits method, for the first year, we depreciate 5 over 15. The second year, 4 over 15. The third year, 3 over 15. Fourth year, 2 over 15. The last year, 1 over 15. So we're kind of going backward. The first year, we're depreciating the most. The last year, the least. And then once this 5 years over, we have 5 over 15 plus 4 over 15 plus 3 over 15 plus 2 over 15 plus 1 over 15. So that's 1. We have depreciated all of our depreciation allocation base. So our allocation base here is 10,000 minus 800. So for the first year, what we depreciate is 10,000 minus 800. And then we depreciate it by 5 over 15. So that is 3,600. It's 3,067. So after the first year's depreciation, our book value is 6,933. And then the second year, we depreciate 4 over 15. So that is 2,453. So after the second year, our book value is 4,480. The third year, we depreciate 3 over 15. The fourth year, we depreciate 2 over 15. The last year, we depreciate 1 over 15. So, and then the last year, after the last year, we have depreciated all of our depreciation base. And then our book value will be equal to our residual value, which is 800. So this is the sum of the years digits method. The next method, declining balance method. So under the declining balance method, the depreciation rate applied to declining book value, not to the allocation base. So in the previous example, we have the same allocation base and we're using different depreciation rate. And this depreciation rate, it decrease over year. However, under the declining balance method, we have a declining book value, and then we're using the same depreciation rate. Rate is some multiple of straight line rate. So for example, if it is double declining balance, we depreciate at twice the straight line rate. And then the final year depreciation needs to be forced such that the book value equals to residual value at the end of the assets used for life. So what do all of this mean? Let's look at an example. Declining balance method, the example, the machine cost 10,000 with 800 expected residual value, 5 years useful life. If we use double declining method, what is the depreciation for each year? So please spend 1 minute, try to work out this example on your own, and you can pause your video for now. So in year 1, our book value is 10,000. And then, so different from the previous one, under the double balance method, we're using the same depreciation rate, which is, so this is a double declining balance. If the firm is using straight line method, each year the depreciation rate is 1/5. So straight line for 5 years, each year 1/5. And then because this is double declining, so we multiply it by 2. And so which means that each year the depreciation rate is 40%. And depreciation rate is the same every year until the second year before the last year. So for the last year, we don't use a depreciation rate. We need to force our depreciation. Otherwise, your book value, the book value that is left won't be equal to your residual value. So we use 40% every year until the second before the last year. And then for depreciation for the first year is the book value 10,000 multiplied by 40%. So that's 4,000. And then after the first year, our book value is 6,000. The depreciation for the second year is we take the book value 6,000 multiplied by 40%. That gives us 2,400. So, and then the book value after the second year is 6,000 minus 2,400. That is 3,600. And then our depreciation for the third year is 3,600. So we take the book value multiplied by 40%. That is 1,44,000. And the book value that is left is 2,16,000. And then for the fourth year, that is 864. And then our book value is 1,296. So, and then for the last year, we need to have a depreciation which make our book value to be equal to the residual value, which is 800. And so our last year's depreciation, we do not apply any rate. Instead, it is forced to be whatever the book value that is left needs to be equal to our residual value. So we use 1,296 minus 800. And our last year depreciation is 496. So if you compare the declining balance method with the previous one, with your sum of the years digit method, you can see that both of those are called accelerated method. what do we mean by accelerated method? Basically, our depreciation is more in early years and less in later years. So we're accelerating the depreciation in early years, and that is accelerated method. So here as well, we're having more depreciation in early years, less in later years. We're having an accelerated depreciation in early years. But what is the difference between these two methods? So in the first method, sum of the years digits method, how do we achieve this accelerated depreciation? So we are actually achieving it by having an accelerated depreciation rate. Or in other words, our allocation base is the same over years. And we are achieving accelerated depreciation by having a higher depreciation rate in early years and lower depreciation rate in later years. This is how we achieve accelerated depreciation, more depreciation in early years. And versus if we're using declining balance method, we are achieving it, we are keeping the depreciation rate the same. And we are achieving accelerated depreciation by having more, the number where because the book value is more in early years. So by applying the same depreciation rate to the book value, we are achieving accelerated depreciation here. So or in other words, we are changing the first part, the previous part, the base that we are applying the rate to. And then this is how we achieve accelerated depreciation in the declining balance method. But both of these methods, the purpose is the same. We're using those methods to achieve something that to achieve more depreciation in early years and less depreciation in later years. So those are the accelerated method. And the last method I want to talk about is unit of production method. And here is the example again. The machine costs 10,000 with 800 expected residual value. It is expected to produce 20,000 units over its useful life. So this year, the machine has produced 4,500 units. What is the depreciation? Please spend 1 minute, try to work on this on your own, and you can pause your video for now. So first, let's calculate depreciation. Depreciation rate per unit. So what is our per unit depreciation rate? So we have the cost of 10,000 minus 800, and this is depreciated over 20,000 units. So for each unit, the depreciation should be 0.46. And this year we have produced 4,500 units multiplied by 0.46, the unit depreciation, and that is 2070. So 2070 is our depreciation for this year.